Maarten-Jan Bakkum is an emerging market strategist at ING Investment Management, joins us live now from The Hague. Thanks very much for coming on the programme. So let me ask you then about what you're reading into the slowing Chinese trade data. How much of a risk does it pose for you to the investment environment, if you like?
Well, the import data clearly was weaker than expected, but I think it has to do as well with the global trade environment. So import growth is weak because export demand is lower. But I think it was still a negative surprise, so we have to really clearly watch out what's going on.
Are you thinking about the possibility then of a hard landing for China, a potential collapse in the housing market, something many analysts are talking about right now?
No, I think a hard landing risk is not that high in China, simply because the authorities know what they're doing and they have room for stimulus.
All right, so you've mentioned about, you've said the trade data is negative, so I'm just wondering if external demand is slowing, do you think then that that is actually going to be a good thing for Chinese stocks because it means that we will see monetary easing? Will that give the equity markets a boost? Certainly today that seems to be the case.
Yeah, I think the authorities have room for stimulus, and this weak import growth shows that they probably will actually have more room and more reason to do more easing.
How much of a risk is deleveraging for European banks, not just for China, but Asia overall? Is that something that you're factoring into your strategy right now, if you like?
Well, deleveraging in Asia is not as big as a problem as it is in Europe and the US. So I think we just have to look at the Chinese numbers in general, on the investment side, on the consumption side. Yeah,
but how is it going to, is it not going to constrain credit to some extent for many of these companies? Do the effects not... does Asia not see an impact?
Well, Asia as a whole, of course, depends a lot from Chinese demand. But I think credit growth in China was actually quite strong over the last few months, and also the latest data were quite good. So I think there's clearly room for the authorities to pump more money in the economy. And I think this latest import data will actually be a reason for them to be a bit more aggressive. So we can expect, I think, more measures in the short term and medium term.
You're definitely buying into China, aren't you? So what sort of returns are you looking for?
We buy into China mainly because of concerns about the global economy. So we think China is more resilient than other countries. And also China was particularly weak over the last few years, simply because of inflation problems. And now inflation is coming down and there's room for stimulus, so China looks relatively well. How large the returns will be, it's difficult to say. We just make a relative call. China for us is a bit of it's a domestic demand play that has suffered recently, so there's more room for performance in the next 12 months.
Are you surprised by this sort of discrepancy that we've seen between economic growth in China, which has been well, more than twice as fast as world economy overall? Are you surprised by that, and then the performance of the Shanghai Composite, which was really the worst amongst the 10 biggest markets in the past 2 years? This is according to data compiled by Bloomberg.
Yeah, well, this is a Chinese phenomenon we've seen already for a longer time, and it has to do, of course, with corporate governance problems, with the fact that Chinese companies are not, like elsewhere in the world, primarily there to make profits. So private investors are not always the first to benefit from growth. I think that's the key problem. And on top of that, of course, the concerns of the housing market bubble, perhaps, and the financial sector that has shown some weakness. So, and that's a big part of the equity market in China. So there's also some sector concerns.
Sure. I'm curious about your strategy for India, because you've said that from an investment perspective, India is definitely one to watch, and yet it's too early to play. Why is that?
Well, I think India is certainly a market for this year. Like China, it suffered last year. And the main reason for that was also inflation concerns. For India, also inflation has started to come down. Growth has been much weaker than expected, but should actually start recovering in the course of this year. But I think on the growth side, indeed, it is maybe a bit early to aggressively play it, simply because the growth momentum has not started to bottom yet. But I think on the monetary policy side, India is clearly one to watch. And the market, actually the year started quite well already for India. So for 2012, India is one of our first markets.